For more, let's bring in Maxwell Grinacoff. He's U.S. equity derivative strategist at UBS. It's a complicated seat that you sit in, Max, but it leads to a very simple conclusion right now, which is?
Yeah, look, home builders are a consumer discretionary industry at the end of the day. We've since seen evidence of the U.S. consumer starting to crack. You see this in the most recent consumer confidence data, household net worth starting to wane, debt levels and delinquency rates increasing, resulting from a lot of those excess savings having been spent down, and labor market data under the hood deteriorating when you strip out areas like healthcare and education. Adding to that, higher oil prices, resumption of student loan payments, the confluence of those start to be more of a headwind for the consumer. As a publication, home builders we're up 27% year to date versus S&P up 13. That's in the face of mortgage rates close to 8%. That's 20, almost 25-year highs. Home affordability, the lowest on record, right?
Yeah. And so it's interesting to me to hear it from your point of view, because we've heard the fundamental case. We've talked to some economists and even some analysts who kind of see these problems. Talk to me about when we're talking about sort of the equity derivatives piece of this and you overlay that, what are you gleaning? And it sounds like you're gleaning this not just about the builders, maybe other aspects of this market.
Yeah, and it really lines up with our bearish cyclicals call, into the latter part of this year. As you alluded to, home builders, one of the few, at least consumer-oriented areas that have actually benefited from a higher rate environment. That's obviously a function of housing supply remaining extremely tight. So if I can't find a home in the secondary market, I'll just go out and build my own, right? So that's been a cyclical tailwind for the home builders. But we do think the space now appears more geared to a cyclical slowdown in the short term. Home builder sentiment has fallen, housing starts and permits have softened, and fundamentally, from an U.S. equity perspective, we've started to see relative earnings momentum start to turn over, and valuations like price to book appear more vulnerable.
Yeah.
If we do get a more volatile macro.
And you have strategies. Yeah. You might want to consider XHB December put spreads. I'm not going to pretend that this is my area of expertise whatsoever. But what would you say about kind of the market pullbacks? I guess it just depends on your time horizon. Is the pressure that you foresee the kind of pressure that goes into year end? Is it something more?
Yeah, no, look, as I mentioned, we've taken a more bearish stance on cyclicals. We've taken a moderately long volatility and long quality bias into the fall and into the latter part of this year. And we've started to see this play out a bit, especially post-September FOMC, as the U.S. equity market interestingly continues to trade this, good is bad, bad is good narrative. You saw with the JOLTS number a couple of days ago, you saw the reverse of that, yesterday. So, the question is what ultimately breaks us out of that? Well, it's, John Pingle, our chief U.S. economist who was on the program earlier, saying, you will start to see further deterioration, in the labor market data. That ultimately, hurts the U.S. consumer, and that ultimately feeds through to, corporate profitability.
Yeah, and he was great. Bad news is bad news again, for
right.
home builders in the housing market. Maxwell, thank you so much for joining us today. Appreciate it.